continue to see a high degree of contrast in the market and the economy today. On the one hand, there is this overwhelming consensus that the U.S. economy remains on firm ground and a soft landing is increasingly in sight. U.S. inflation is falling, unemployment still low, and as recently as April, Fed Reserve Chairman Jay Powell said the economic picture continues to be one of solid growth. U.S. stock markets have paralleled this optimism by surging to new all-time highs in the second quarter. On the other hand, though, if we look beneath the surface, we are seeing increasing fragility in both the economy and the stock market in the U.S., and we think it's something that investors should be cognizant of. For the economy, you don't have to look further than the consumer. Credit card delinquency rates continue to deteriorate pretty quickly, spending growth is lukewarm at best, and consumer confidence surveys imply that the average person expects their future conditions to deteriorate significantly. In other words, people are feeling pretty tapped today. Starbucks, for example, has seen unusual weakness in coffee volumes this year, and there's been a sudden drop in the growth rate of people eating out at restaurants. Against a backdrop where U.S. housing affordability is the lowest it's been in over 20 years, we can't help but wonder, if consumers are worried about the cost of an extra latte, how willing are they and how able are they to buy a new house? While unemployment remains low, it's concerning to see trends worsening in economy-sensitive areas, trucking, small business, and construction. An interest rate cutting cycle to provide temporary reprieve, history's shown damage is usually done by the time central bank rate hikes are reversed. If we look to the stock market, return and index weights have rarely been so concentrated. In the second quarter, 7 high price-to-earnings AI-related stocks drove the entire return of the S&P 500, of which NVIDIA accounted for 44%. It's no secret that the earnings of these businesses have been extraordinary, but investor crowding around businesses perceived as having idiosyncratic growth is classic late-stage bull market behavior. Meanwhile, many other areas of the market fell in the second quarter. Aggregate earnings growth for the S&P 500, excluding the Magnificent Seven, was actually negative. If the economy is as strong as the Federal Reserve contends, then why are so many economically sensitive areas of the stock market floundering? Against this backdrop, there really appears to be an overexuberance in investor sentiment. Retail investor exposure to stocks is at an all-time high, beyond even the peak of the tech bubble, and there's been a surge in risky behavior for the average investor in 2024. For example, day trading in speculative penny stocks surged as a percentage of total U.S. trading volume by 7 times at one point in 2024, while asset flows into risky triple-leveraged ETFs have surged as well, up 3 times from recent lows in 2023 and up by a factor of 10 times from pre-COVID levels. People are really betting hard that stock prices will continue rising today. Contrast this behavior with comments from Warren Buffett in Berkshire Hathaway's annual report this year, where he described his opportunity set as it being endlessly picked over by us and by others. What opportunity then is the average day trading retail investor seeing that the Oracle of Omaha is not? As bottom-up investors, we don't spend much time trying to predict the stock market. But with U.S. market valuations, expectations for earnings growth, and consumer sentiment all at historical highs, it looks like there's little margin for error today if expectations disappoint. Longer term, current starting valuations in the U.S. today have been historically associated with relatively unattractive future price returns over the next 5 to 10 years. In the short term, however, investor sentiment and liquidity are the primary factors that will drive stocks up or down. And given the prospect for continued strong near-term earnings growth among the large mega-cap companies and the degree to which momentum has been driving recent stock market activity, we think it's possible that current AI-driven bull market themes may continue their upward trajectory in the short term, despite the growing risks we see. This all said, any disappointments to expectations for re-accelerating corporate growth, further deterioration in employment, or additional geopolitical shocks or even the presidential election could prove to be pinpricks that unwind the optimism that's baked into current equity prices. Finally, we'd also note that an interest rate cutting cycle has begun. Both the Bank of Canada and the European Central Bank began to lower interest rates in the second quarter. Federal Reserve will likely follow suit by year's end. Stock markets tend to initially applaud initial rate cuts with higher prices in the near term. The start of a rate cutting cycle typically arises in response to underlying deterioration in the real economy. More often than not, it accompanies the tail end of an economic cycle. All of this suggests investors should keep risk management top of mind. We've always believed that some humility and a process grounded in owning good businesses, reasonable valuations is the right long-term approach, regardless of what is happening in the stock market. It doesn't ensure that we'll participate in the extremities of market-dominating themes, such as the current AI craze, but we found it does provide a framework to generate consistent, risk-adjusted returns while avoiding the worst excesses that can accompany such forces. Today, our strategies continue to look as attractive as they did in other periods where we were worried that equity markets could be leaning too far over their skis. Our balanced strategy continues to have a defensive bias, a slightly more conservative mix to bonds. And in the near term, this focus on risk management has created some incremental drag on performance, but we think the fundamental attributes of our strategies continue to suggest satisfactory outcomes for clients in future years despite what broader market concerns we see today.